Good afternoon. My name is Kelly Buckley. I'm managing principal of the Western Investment Advisory Firm. We are an elite level wealth manager based in Nicholasville, Kentucky. And this is our first opportunity with Facebook Live. And we're opening ourselves up to all of our guests and clients who might be on listening today to talk a little bit about the markets. And the title of our talk is Pandemics and Recovery. But we're going to get into the history of these type of events as we go through your questions, but primarily we're here for you. So if you have a question, please go ahead and submit it now, and that'll form the basis of what we do going forward. Until I see some of those questions, I'm going to address a few that I think many of you might be wondering about. First, what's the likely movement of our nation's equity markets over the next quarter, the next year, with the impact that the world's worst pandemic so far, at least in the 21st centuries, has laid upon our economy and the world's economy. And I want to try to keep this fairly uncomplex, so I'm going to give you as brief an answer as I can. And if it inspires other questions, please go ahead and post those. First, we're used to having pandemics. Pandemics occur every 5 to 10 years. A pandemic is defined as a movement, an epidemic within multiple countries. And as I'm sure everyone listening is well aware, this pandemic has affected virtually every country on the globe. Pandemics can be uncontrolled, like the Spanish flu pandemic in 1917, which killed millions. And with current vaccinations and the ability of our scientists worldwide, and especially in the United States, to find vaccine help, to use plasma treatments, etc., we found that over the years, the net effects in terms of death and illness have tended to be muted out. This one was a little different. The coronavirus is a virulent strain and tends to infect at what appears to be a much higher rate. This caused a lot of fear, and our nation's reaction to that fear, both at the state and local levels and at the national level, was to seek an immediate solution. The immediate solution was obviously social isolation, social distancing. In some states and local governments, it's gotten a little bit more serious, and I'm sure you guys have read some of the stories. Arrests have been made even for attending church services in your car. This type of activity by our politicians has bred fear, I think, that's at a very, very high level and probably not a productive level. But on the flip side of that, I think it certainly at this point has gotten us through the peak of the curve and allowed our medical facilities not to become completely overburdened and overrun to the extent that our medical professionals can't work because they're all sick and where patients don't have a hospital bed or a ventilator. So those predictions, of course, were made. They did not occur. I think they're extremely unlikely in the future. But how that affects your investment can be discussed in many fashions, but obviously there's an immediate impact. Markets declined more than 20% in the last 4 to 6 weeks in terms of equities. The bond market actually was buoyed by this because the Federal Reserve of our nation acted appropriately, as other central banks did, and forced interest rates on the short end of our yield curve down. That provides support to bonds that cause the yield curve to fall. So bond investments have held up. The history of the quarters following these type of events is very delineable, meaning that we can go back and look at it, and it is unanimous that in quarters past these type of events, we tend to see very, very strong upside movements. Somewhere around a 7 to 10% return would be normal. What our firm has expressed to its clients is our belief that this pandemic because of the rapidity of the sell-off, with most of that over 20% equity market decline happening in 3 weeks, is very likely to result in a market sense, equity market sense, a V-shaped recovery. Markets fell hard and fast, and we're seeing signs that the upside will be equally fast. Today, we're seeing significant upside movement in all of the indices, the S&P 500, the Dow Jones, the NASDAQ indices, and in our own portfolio. And this is based on several things. One of them is an announcement yesterday that a drug company called Gilead had come out with some very compelling studies that would suggest that a drug that has been on the market for the treatment of Ebola, in some cases AIDS, seems to be highly effective. We know other treatments are effective. We've seen antimalarial drugs ease respiratory distress and get people off of ventilators. There are several studies going on right now that involve folks given placebos of these various treatments and those given the treatment itself that are very clearly showing that we're making headway against this particular pandemic. We also know that plasma treatment is effective. Plasma treatment is where someone who has had this disease or any viral disease and develops antibodies in their bloodstream can donate their plasma and help 4 other people recover. There's also something called the herd effect. And the herd effect is that those who have had the disease and recovered are virtually inoculated. They can not only provide plasma, but they reduce the onslaught against our hospital undercapacities by inoculating a large part of the population that's been exposed. So in terms of our financial markets, it's our core belief that the various treatment options that are being rushed through approval, rushed in a good way, not bad, are very likely to be effective and are very likely to take much less than the year to year and a half that is still being talked about and was initially applied to the development of an actual vaccine. And we believe that vaccine is going to be produced at a time that'll be less than a year. We believe that other modalities like plasma treatments and malarial drugs, etc., are likely to be highly effective. This is going to result in getting our country back to work on a timetable, as we've said since late February, early March, that's significantly lower than had initially been estimated. It appears that the many states, 7 states, that never had lockdown instructions are moving well along the curve and simply do not have fatality or illness levels that would justify, in looking in hindsight, the shutdown of their states. So we think that given the president and his administration's announcement last night that there is a good game plan in place for a 3-phase reopening of our economy. And of course, those phases that will be applied will initially occur in states like my own, our own, Kentucky, where the pandemic has not done the damage, has not seen the widespread nature, and has not caused the greatest destruction. We think that states like that are likely to open quicker. And the quicker we get folks back to work, the quicker we slow down the law of unintended consequences, because closing our nation's economy could cause real long-term economic damage. At this point, given where we are on the curve, and also given the Trump administration's announcement last night on how we're going to reopen our economies, we simply do not believe that there's going to be any great or long-lasting economic damage. The economy is the important thing to keep your eye on here. How the economy performs is going to dictate, in large part, how your portfolio performs. What our firm expects from this V-shaped economy is a very rapid upside movement as the economy reopens, driven primarily by the fact that just 6 weeks ago, we were sitting on the greatest economy in the history of the world, literally. The greatest economy that our country has ever seen. Now, that means there was a lot of underlying strength when this pandemic attacked. And as we come out of that dark cloud of pandemic, we've also tossed a minimum of $8 trillion of stimulus on top of this recovery. $8 trillion is about a third of 1 year's total production and services in our country. It also provides 4 times the total stimulus that was brought to bear in the last called Great Recession of 2008 to 9. That type of stimulus is going to generate a lot of economic activity. The Trump administration's Paycheck Protection Program, which our firm participated in, filing Friday before last, receiving 2 months of our employees' salaries today, took approximately 10 minutes to fill out the application on. That means that our employees have no problem getting their paychecks, even if they're not here, even if they can't work at Spectrum Financial Alliance. That program is going to support their consumption. That consumption is going to drive our nation's productivity. The stimulus that's been applied to this is going to cause this economy to rise to a level, we believe, sometime in the third quarter of this year that will equal or exceed the old economic highs and cause our investments and the indices to exceed their old high. We believe that in the fourth quarter, the market will hit new records and march well beyond them. And when we wrap up 2021, it's our belief that the economy will have provided a rate of return that will be quite acceptable to equity investors. Something else is going to happen out of that type of economic resurgence, though. At some point, we're going to see interest rates go up. We would anticipate long term that they approach levels that we last saw in the 80s, 14 to 16%, 30-year Treasury bond returns. Now, that's very long term. I'm talking 5, 10 years. But interest rates move in long cycles, typically 20 to 30-year cycles. This upcycle that we're currently in before the pandemic began about 2.5 years ago. So we've got a long way to go. That also has another prong to it, and that's inflation. Interest rates and inflation tend to move in the same direction. So we also believe that at some point in the next 5 to 10 years, we'll see 80s level inflation levels, where you're looking at 10, 11, 12% per year. That is the death knell for bonds. And in our view, bonds are the biggest investment bubble, literally, of all time. Many of my clients who I've been privileged to work with for 30 plus years were with me when we saw the last great interest rate rise in the mid to late 80s. And then the subsequent fall in those rates. And we made a lot of money in that decline because we used a lot of bond elements. We believe that the bond elements that are in many investors' portfolios now are likely to be highly problematic and would encourage people to examine their bond holdings, realizing that those bond holdings are going to cause significant declines in your investment accounts, intermediate and longer term. Right now, they're probably fairly safe and stable. But as we get into the mid to late fourth quarter of this year and in subsequent years, we think they'll be very problematic. I see a lot of our clients are already signing on, and I'm looking at some of these comments. I won't read them because you're making me blush. Thank you guys for your faith in our firm and our firm's guidance. Our firm is about success for our clients, and we're about winning. And we work very hard to make sure our investments and our strategies allow that. I think on that topic, I want to address another question. Projection for the market rebuild and time frame. Now, I've covered a lot of that. But let's talk about actual returns. When we began 2020, without knowledge of the pandemic that was getting ready to come our way, we felt like this year would be a returning year that would be well above a normal 10% equity return. Now, given the damage that was done in this first quarter and will occur somewhat as the economy reopens in the next, say, 6 weeks, that number is likely to be muted somewhat. I still think the return will be close to or exceed a double-digit level. In other words, above a normal year's equity return. And as you're getting online now, please feel free to type in your questions. I can see them here on Facebook Live, and I'll be glad to address those. More important than the rest of this year, though, I want you all to know honestly, I have never seen a period net of this pandemic, net of this past 6 weeks, and perhaps the next 6 weeks, that was as healthy and is fed by right-sized policies. And I'm going to give you an example of that. We all of us, every single one of us, have a heart for our immigrant community. And I think most of us have had the opportunity and the privilege of working with them and seeing side by side where their hearts are. And the vast majority of them are good people. But we've shipped a lot of American jobs overseas, and we've taken a lot of American jobs off the market domestically because large corporations in our country for the last 30 years, many of them working through the U.S. Chamber of Commerce, have sought cheap labor. And in fact, they're doing that now with Americans laid off by the millions. They're bringing folks in on H-1 visas and taking jobs that we have Americans available right now to fill simply because they want to lower their cost. Speaking as American, speaking as a Kentuckian, I want to pay people fairly. And I don't want to undercut the value of their labor by bringing in folks from other countries who are, I'm sure, well educated and well intentioned and exploiting them, exploiting their labor. That's what's created this two-tiered income system that we have in our country right now. And when I say two-tiered, if you look at, say, the top 10% of income earners, they've done quite well in the last 10 to 15 years. The middle class and the lower middle class haven't. And that income disparity has grown. But it's been because of governmental policies, not the evil in the hearts of corporate CEOs, CFOs, and managers. They're not evil. They want to help people. But these policies have driven immigration, and in fact, they've driven illegal immigration. And the policies of our new presidential administration 3.5 years ago have led to a great slowing of that hemorrhaging of American jobs. And in fact, have already returned millions of jobs from overseas. This is healthy for our country and for our economy. You're going to see more jobs returning from factories overseas due to this blow up with China on the coronavirus. I think our government is making it clear without revealing sources and methods of their intelligence that there were problems not only in the earlier possible reporting of this pandemic by China, which could have saved hundreds of thousands of lives, but also in the fact that we've got many of our supply chains, our factories, pharmaceutical factories based in China. And when Chinese government officials threaten the United States to slow down the shipment of pharmaceuticals to our country, I think that's going to lead to an ever faster movement from China, which we were told by the previous administration would surpass our nation's gross domestic product by 2019. Well, that didn't happen, not by a long shot. And it's not going to happen as long as trade policies are fair. Fair trade policies mean that each country operates to its competitive advantage and produces products and services in which they have competitive advantage, and then all countries benefit. It doesn't mean that we give them jobs and thereby deprive American citizens of what truly is their birthright, their ability to produce an income for themselves and their families. I think that's a good thing. It's a positive out of this huge negative of the coronavirus. Another question that I'd like to cover is what would I say to somebody that's, let's say feeling a little fearful or, concerned, scared, nervous. And I've talked to many folks like this. Some of them are clients. Some of them are family members of mine. And, my experience with fear and greed, I've written about a lot. It's on our letter blog on our website at www.spectrumfinancial.com. Fear and greed are the two most destructive emotions in mankind's history. Fear causes an immediate flight or fight reaction, both of which may be wrong. And I think fear debilitated this market. I think much of the fear that existed was hyped to a great extent by media sources. And I understand that. They've got a job to do, and their job is to sell their news stories. And sometimes the more sensational those stories are, the more people click, the more people buy. And that led to an exasperation of the fear. And the more our society is interconnected and the faster information flows, the more that type of thing is going to occur. But fear caused many Americans to make a terrible decision in their investments. And folks, we had a client that sold everything against our strongest advice. And what did that lead to? What it led to is, since we called the low on April 2nd in our social media post to you, we called that low on March 23rd. That's where we said we felt like our charting was telling us the low had occurred. Since that time, our clients' accounts, net of costs, are up a little over 25% as of right now. Now, the problem, if we had dove out of the market, gotten out of the way, is that requires perfection on two fronts. The first front is you have to leave at the right time. And of course, this pandemic caused a massive 3-week sell-off, happened very quickly, and we had very, very imperfect information that we were trying to act on. So there's your first decision. You have to make perfectly. When do I get out? The second decision, and this is the really tough one, would be, when do I get back in? When do I make the decision that I'm going to reinvest the money I just took to the money market? This is the one that trips investors up every single time. That's why our methodology, given short-term events like a pandemic, does not allow us to dive for cover. When we dive for cover, as our clients have seen in the past, is when our analysis reveals we're actually in a recession. Recessionary events tend to last on average 13 months. Some are significantly longer, some are significantly shorter. But if we think it's a recession, we're going to liquidate significant portions of our client accounts. The last time we were in that situation was in 2009, and we took about 75% of our clients' money to cash. Now, that methodology then is what also kept us in the market in December of 2018. And you guys might remember this who've been with us for that long and longer. In December of 2018, economists and news columnists and virtually everybody was talking about yield curve inversion and recession. And we wrote widely about this. And again, it's on our letters blog. And we made it clear, based on our analysis, that we did not believe there would be any yield curve inversion, long or intermediate term, and that there was very unlikely to be any type of recessionary event. And even though we had seen about a 20% decline in that fourth quarter, most of it being in December of 2018, that we felt that was a very short-term event. And it was, and no intermediate term or long-term yield curve inversion occurred, and our clients' returns were over 38% net of cost. That's all accounts as computed by Morningstar Inc. Disclaimers to follow when we get to the end of this discussion. So perfect decisions. It's hard to make a perfect decision with little information. We try to ignore technical events like 2018. We try to ignore short-term events like we've experienced in virtually a 3-week period, now stretching to 6 weeks into the recovery. Doing that does keep your assets safe. When you look at your accounts and you look at your statement, for example, for March, it looks terrible. But that's a very short-term event. No long-term or intermediate-term loss is likely to occur. The evidence of that is, again, going to the March 23rd low call through yesterday's close and into today, we're up over 25%. Now, there's going to be down days, folks, and please don't think I'm saying everything's going to be rosy. Those of you who've known us for a long time, you know that. But those down days are going to be far fewer than the up days as economic activity continues to increase and as stimulus begins to be felt. And remember this, until this week, we didn't have the bulk of Americans who'd even received their stimulus checks yet. We hadn't gotten our PPP check. Most folks hadn't gotten it. PPP, the Paycheck Protection Program that goes to business owners and allows them to pay their employees for 2 months for the business interruption that's occurred. That's going to get the economy ginned up in a big way, and it's going to lead to further significant gains. So, if you're scared or you're nervous, life is funny. It doesn't matter what the situation. The glass is always half empty or it's half full. Example, this latest pandemic caused interest rates on a very short-term basis, in our view, to fall significantly. Caused the Federal Reserve to reduce their key lending rate down to 0 to 0.25%. Again, that's really unusual. And making lemonade out of lemons. I refinanced my mortgage again. And that's going to save me a lot of money on a monthly basis. So we try to look for these bright sides. And if you're fearful or you're feeling anxious, you can do that too. What can you do to improve your position? What can you do to adjust your budget? And if you don't have a budget, you can go online and Google it, and you can do a budget. There are so many things that we found in this time with our families and at home that we didn't really need. We build a much larger sense of community, thank goodness, because we need to. We need to end the bipartisan squabbling that's going on up in Washington, D.C., because it allows nothing to be done for the people that are paying the piper. And that's all of y'all and me as taxpayers. So use your fear. Use your fear to motivate you, to learn something new. When you're fearful or anxious about your finances, please remember this immutable fact. We have never, ever in the history of our country had a situation like this that did not recover. And in most cases, led to quick recoveries, 6 months or less. We're going to recover from this just like we recovered from 100% of every recession we've ever had, just like we recovered from the Great Depression. And no one who tells you differently is telling you the truth. Anyone who encourages you to liquidate your investments and go to cash is not only extremely foolish, but in our opinion, if they're in our industry, they're creating financial malpractice situations for themselves. This is not something that's new. We've had many, many pandemics, most of which, when all said and done, would have a death rate that's going to be equal or close to equal to the one that arises out of this in all likelihood. Social distancing worked, may have been a little bit overblown in areas like ours, wasn't used except with normal common sense in 7 states that did not lock people down or tell them to go home. In our state, our governor is doing renovations in the governor's mansion right now. There's workmen all over that mansion. No one's wearing a mask. His kids are running around. He's all over the mansion. So some of the folks that are governing us need to have some of their own medicine. And let's remember that the government officials that are in charge of giving us direction, their paychecks do not stop in a pandemic the way other Americans as employees and business owners' paychecks literally have stopped. So it may not be as important to them to get our economy back up and running. But as we saw in the state of Michigan over the last couple of days, civil disobedience is now starting to rear its head. And I think Americans in general are realizing that this thing is overblown. And as someone over 60, I'm in a threatened group and medically compromised. And, I know it's going to affect people in my age group, could affect me, could affect my wife. But I think shutting an economy down should only be done in cases like a New York City situation and should not be implemented nationally, particularly not by politicians that may not have their citizens' best interests at heart, but may be thinking about the politics of the situation. Okay, another question that was given to me. What advice do I have for people who are contemplating liquidating their assets or stopping 401k contributions? This one is really easy. I said I believed sometime in the third quarter, could be early third quarter, the market is likely to approach its old highs. If you have bond elements in your 401k, your retirement plans now, or even your investment accounts, liquidate. Interest rates at zero have nowhere to go generally but up. And as they go up, the value of your bond holdings will go down. Move your portfolio into a higher weighting in equities, understanding that with this much stimulus and with the world's strongest economy just in late February of this year, we're likely to see a very strong resurgence. In fact, if you are contributing 5% to your 401k, double it. If you were at 10%, double it. Because now you're dollar cost averaging and buying many, many more shares at a much lower price per share than you could previously. Even if you can only sustain that for a very short period of time, you should increase your contribution. Economic history is very clear on this point. The economy has never failed to recover, even from serious recessions. This isn't a recession, it's a health event. And it's not going to last through the rest of the year. And I know there are many medical experts that believe it will, but I don't think that's correct. I don't think the administration's policy or our governors would want their economies to be shut down and would want people unable to get out of their houses, go to work, go to church. Most governors wouldn't. So our history is clear, and we have come back 100% of the time. Keep that close to your heart. Remember it. And if you'll allow that thought to permeate your thoughts, then your options are a little clearer. And you should increase your contribution rates, increase your rate of investment, And if you're one of those folks who did go to cash, or maybe you were in cash, and more power to you, maybe you're in cash when the decline started in March, get your cash working for you. The only investment that's guaranteed to cost you money after inflation and taxes 100% of the time is cash. I remember back in the 80s when I could put money in my money market fund at 10%. And of course, I was a very young man then. And I remember thinking a few years after, and I'm going, I put money in the money market at 10%. But the year I did that, inflation was 12%. So I lost 2% of my capital in real terms to inflation. And I had to pay taxes on the 10%. So after you net all that out, I lost about 4 or 5% of the capital's purchasing power that I had in that depository account. But that year, when inflation was running high, corporate earnings were being inflated too, and equities went up a lot more than normal. So don't leave your money idle. Don't allow fear to permeate your soul, and increase your 401k contribution for as long as you can. As long as you can. If it leaves you a little short, look at your budget and see what you can cut out for a few months. You will be very, very happy you did. 5 to 7 years from now, we believe the market will have doubled. That's how much economic pressure is on a market that in February, due to the change of policies that occurred in how our economies run, both in taxation, in trade, and in immigration, those policies drove significant economic activity that caused equity values to rise. Those values will rise again, and that economic activity will come back. It's virtually unsuppressible, and it certainly isn't in anyone's interest to suppress it intermediate term or long term. So as this economy grows, we believe that 5 to 7 year period will find a doubling in the indices. And we believe our economy will perform our investments are likely to perform in line with that or above it. Looking to see if there's any questions that you guys have. And I don't see any right now. Pardon me 1 second. Oh, we're
Any opportunities in sectors we're not currently in?
Okay, pardon me. I have a very good friend and client who's asked a question about opportunities in sectors that we are not currently in. And I won't use names, I'd like to, but it's kind of one of those HIPAA things. If you're in the health industry, you really shouldn't do that. But there are significant opportunities in other sectors. And if you followed my trading activity this week, you've seen me lighten up in certain investments and go into other investments. And I made some moves about a week and a half ago. The sectors I am more attracted to right now are sectors that, and kind of have on my watch list, are sectors that are travel related. One of our recent purchases is Delta. I think Delta is the elite level airline in the industry, the airline industry. And, basically, if you look at their valuations, you're looking at a company that's trading at significantly less than half its historic multiples, price to earnings growth, price to sales, price to book. And it's being priced at a level that says we're going bankrupt, or that says air travel is never going to reoccur. And that's just foolish. That's not what's going to happen. And I think we'll all kind of appreciate that in another month as you see the vast majority of our states open back up for business. So we're looking at industries that have been adversely affected. A move I made yesterday was to lighten up in our traditional banking sector. I sold JP Morgan, and I didn't want to leave the banking sector, didn't want to lighten up in the banking sector because it is truly undervalued by about 100% right now versus where we believe it's likely to be in a year. But I rotated that money and added some from the JPM holding, JP Morgan Chase holding, into Capital One. Capital One doesn't have the real estate exposure that a JP Morgan Chase does. It has more consumer debt exposure. And with the Paycheck Protection Program, the stimulus program, and other things that are being done to protect the income of Americans, we're anticipating that the unemployment rate is going to come back down rapidly as businesses reopen, and that consumer debt write-offs will not be the issue that the market is saying with Capital One and other lenders that they're going to see. So there are other sectors that I always keep on a watch list, and we have made some immediate moves, including in oil. We have an oil component in our portfolio now. And the reason I'm doing that is, again, it's contra to, say, the market's belief that nothing's ever going to happen in the world again, that we're going to stay shut down for years and years and years. And so oil prices plummeted to a 1974 level. That's just, to me, economically, looking at it from a historical perspective, that's foolish. So we want to stake in that because we're certain that as the economy reignites, as states, governors allow their states to reopen, as the CDC's policies are followed, that people are going to start driving to work again, and that their families who have been cooped up and had to cancel multiple vacations are going to be on the airlines again, and that oil consumption is going to go up significantly. I'm certain of that. It may take a few months, perhaps, because there's reserves that have built up, of course, in this last month and a half. But it will happen, and oil prices will get back to a level that's more in accordance with their historic norms. Other questions? Okay. Then if no one has other questions, we would love to have your feedback about how this medium of communication is seen by you. I want folk, it's hard to imbue my confidence in what we see going forward. And I know some of y'all who are great people may not fully agree, or you may see it differently. But I am certain of the path forward. And I am a student of economic history. And not only am I and my associates here who work for you confident about that path, but we want you to feel that confidence. I want to close with this. You know, I was privileged because I got to grow up with a lot of World War II vets. One of my dad's best friend was a B-29 pilot. Great man. Many of my clients were World War II veterans. This greatest generation that we are at the tail end of now, my mother-in-law, you can't give them enough credit for building this country, for putting mankind on the moon. They did everything for us. And to compare what's occurred globally with a World War II is ridiculous. This is nothing more than a short-term blip in the history of mankind and in your investment history. And when we look back on it in a year, I really and truly believe that that's going to be more clear. But I want to humbly thank you for your trust, your faith in us. You know, I've had the privilege, the God-given privilege of building a multi-generational firm over these last 5 years, and got great people, not good people, but great people who I get the opportunity to come to work with every day. And they've been here every day. And We appreciate you. We appreciate your families. Our hearts go out to those who have suffered any angst, any emotional pain, but we are confident of the future, and we want you to know that. Please feel free to call me if you have any questions whatsoever that go beyond those I may have touched on. Please give us your feedback. Let us know how we did. I'm not looking for compliments either. Tell me what we can do better. Tell me if there's something you may not have asked that you think we should cover in a setting like this, or if there's other mediums that you'd like us to communicate with you in, and we'll do our best to do that. God bless you and your families. I hope everybody's healthy and safe and well, and we appreciate so much the opportunity you give us to help your family build a better financial future. Have a great weekend. Go Cats.